a real edge until we start to understand how things are priced in the market. So when we're looking at options and we're looking at trading around earnings, for example, what we're really looking for is a tradable edge. So we're looking for a mispricing in the option where the market says it's worth $5 and we think it's worth $3, or the market says it's worth $5 and we think it's worth $7. For the average trader, they're not really too worried about that little bit of change in price, but that's actually where professional traders come in and get to take the lunch, because that little bit of price inefficiency actually dictates whether or not the trade is profitable for the person who's buying the option. So what I do is I filter. So I have this part of my tool here, right? So I go into my tool and I go into earnings trader here. And then from there, I have this right here, which is my scanner. So this looks at 1,400 of the most liquid equities in the US. And basically I set in a bunch of filters that I use to find trades for today, for tomorrow, for whatever time frame I'm looking at. So the parameters that I use, I typically start with, let's say we're just looking at today after hours. So it'd be 0520. Time of day is 1630. And then one filter that I like to add, I have two that I like to add. I like to see price over $20. Right, so let me change this, 20. And I like to see the average option volume over 4,000. Just give me 1 second here, guys. So over 4,000. Oh, wait. Oh, that's okay. Let's do 2,000. Okay, so it looks like we have one trade today after that really meets my requirements. But if we were to drop that, right, we can actually see there's a few others here that fall pretty close to it. So I'm going to take a look at take two to show you exactly what I'm looking at. I'm going to take you through the full process of finding a trade. So this is one that I'm looking at for after hours today, TTWO. So once I find a trade that meets my requirements, I take a bit of a deeper look. So I come in here and go, okay, what am I seeing? So they have confirmed earnings date on the 20th. Perfect. And what we can see here is that the implied move. So to break it down, there's really a couple of things that I consider every time that I look at an earnings trade. The first is there a difference between what historically happens around this event and what's happening this time? So what is the market thinking the stock is going to move on this earnings event versus how much does it typically move around earnings? The second thing I look at is, if I were to be buying options around the earnings, how would I have done historically, right? So over the last 3 years of events, and that's this historical P&L here and this earnings move, this shows me historically, how would I have done buying options and how would I have done at each event relative to what the market thought would happen? And then the final thing that I look at is I'll go out and actually try to figure out where could a surprise come from. So when you end up getting a big move on earnings, you typically need some sort of a surprise, because if a company has earnings, let's say this Friday, and they come out today and say, and they tell you how bad it's going to be. They're like, our revenues are down, X, Y, Z. And they're in an industry that we know has been affected by COVID. We have a general idea that, they're making no money. We know that earnings are going to be bad. If that ends up happening, the market will have already priced that in today and you won't see a big move on earnings. But what might happen is, even though we won't see a big move, the market could still be implying a big move. And when we come across a situation like this, that's when we want to be shorting the options or selling the options. So let's take a look at TTWO, right? So the first thing that I look for, is there an edge, right? 8.13 compared to the average move of 7.676. So what we can see here is, yeah, there's a small edge, right? There is a small edge that we can actually take advantage of in this trade. But when we're trading something like this, you wouldn't want to trade just this one event. You'd want to find a bunch of other things that you can place trades on to spread your risk, because the edge isn't huge here. If we look historically, if we had been buying straddles, so basically buying volatility around these events, what we can see is that it's actually been historically pretty unprofitable, right? The last earnings event saved them a little bit, and you would be down over the last 3 years of earnings trading, you would be down 12%. So the edge isn't massive here. But what we can also see is, if you're going to get a big move, it's going to happen around now. So what I would actually say is, if you have a directional bias on this, you can actually make a trade. But in terms of a strict volatility play, I would probably actually stay away from this. I don't think there's enough juice here for us to really make it worth our while. And if we move on and keep looking at other companies, I'm sure we're going to find something that's a little bit juicier that we can start trading. So let's take a look here. If we go to what's releasing tomorrow morning, for example. So we do 2020, 05 to 9 a.m. We see there's another one that meets all of our requirements here called MDT. So let's take a look at MDT and let's see if there's anything that's worth trading there for us. Let's see. So this has a bit of a bigger edge. Wow, this thing never moves much around earnings, eh? This is like full of just really, really tiny moves. Anyone know what kind of company this is? Let me see. MDT stock. Let's have a look. Medical device company. Okay. Headquartered in Republic of Ireland. Okay, cool. So they make medical devices. I'm sure that they took a hit as well. With the market, pretty much moved in line with the market, and made its little recovery. But it's implying a very small move actually for this upcoming event, which is kind of interesting. Typically you would see a pretty big move around these types of events, but let's have a look here. Right now there's a small edge. So we see 2.4 is the average move and 3.3 is implied. So almost a 50% higher move than usual. But our forecast for what the market would think was actually 5.3. So the market might actually be being a little more reasonable than what we originally were forecasting coming into the event. So this forecast right here, this is not our forecast for how big the move is going to be. Like using some pretty complex math, what we've done here is we actually are forecasting what we think the market will think it'll be. So it's like a derivative of the implied move to like what we think the market will think. And what we really use this number for is before an earnings event, we can trade the spread between this number and this number. So if the earnings event was in a week, I could like buy the options today and sell them the day before the event. Hopefully, if our forecast was more accurate. For this one, it wasn't. Obviously, forecasts aren't always 100% accurate. They are on average though with the math that we're using. So what we would do here is we would buy the options now and sell it before the event. And this increase in implied move would hopefully increase the value of the option moving into the event, and we could capture that spread. No problem, Pranav. What's going on, Inland? It's good to see you here. And Lawrence, always a pleasure to see you here, my man. Really glad you tuned in. Lawrence, you have access to this stuff, so make sure that you're taking notes here about what each of the little features does, how we use them, because earnings season, it might be wrapping up right now, but we've got another one coming just around the corner, right? It's 4 times a year. It's 6 to 8 weeks each time. It's probably the juiciest time of the year for options trading, to be honest. So make sure to take notes here, man. So something that I like to see when I'm trading earnings is a graph like this. This right here gives me a lot of great insight, right? The historical P&L. So this tells me that buying straddles around at the money strike has been historically unprofitable. And the way this is calculated is if you had bought them at the close the day before and sold it at the open the day after. So like literally isolating the earnings event as much as possible, how would you have done long volatility is what we call it. So betting on there being a big move. And as you can see here, it normally doesn't surprise. You'd be down 28%. So what I would do here is I would once again be short volatility. So I would be selling the options. So Pranav, this is not a standalone software. I do have a small group of traders that I do give access to. My partner and I are in the process of building out a professional options academy. We're in our closed alpha though right now. So we're only taking a really limited number of people. There's about 10 spots remaining. If you wanted to inquire about it, you can actually shoot me a DM on Instagram at Predicting Alpha, or you can actually send me an email at sean@predictingalpha.com. So I'll put my email in there for you if you want to send me an email. Just looking for some passionate traders to work with us on this project. We have 35 members so far, and it's been going very, very well. So if you want more information, shoot me a message. We can arrange a call. We can talk online, whatever works for you, man. So what I would do here, this is actually a trade that I would consider taking. I would short volatility here. I would definitely be short volatility here all day. As you can see, almost every single event, the company has not surprised on the earnings. It's been, underwhelming every single time. And look through earnings events, right? Like if we take off this timestamp and we look at some of the other events that are there, like let's look at Baidu, for example. Right? All of these companies, the majority of them actually have a very familiar looking chart for the historical P&L. So does anyone want to take a guess why we always see a negative P&L for this historical straddle? We don't always see it, by the way, but we usually see it. This is a common thing with companies, and this is actually where a lot of our edge comes from as earnings traders. So, but guys, take a guess as to why this historical straddle P&L is always in the negative, right? This is if you're buying a straddle at the earnings event, right? Take a guess, guys. I want to see what you guys think. But moving on, until I get those answers, looking at Baidu here, right? Baidu is, it just has, good option volume, good price. Everything's looking pretty juicy here. It's releasing on the 21st at 4:30 p.m. So this would actually be a trade that you would put on tomorrow. You would not put this trade on today. But what we see here is, a small edge once again. Looks like it's pretty efficiently priced. And guys, take a look at this. Remember how on the last stock I was showing you that the forecast and the implied move, we're trying to look for them to come closer together? As you can see on this one, they actually got pretty close. So if you went back in time to maybe like a week or two ago, and you saw that this implied move number was low, like let's say it was like 2%, you would still see this 6.39% number here. And what you could do is you could have bought the options for this stock 2 weeks ago and sold it today. And this ramp up in implied volatility would have actually generated revenue for you, right? It would have increased the value of the option that you were trading. So so let's just take a pause there. Let's go back to this historical straddle P&L, trying to understand why it's always in the negative. And what Siddharth is suggesting is that people expect big moves on earnings, and they're usually directional bets. Okay, so that's a good guess. You know what? Like, it definitely has something to do with it. But why is it always negative? What makes people overstate how much something is going to move? So to break it down, what it comes down to is trading around these earnings events. There is always a risk premium baked in to how much it's worth, right? So if you wanted to buy an option on a regular day, its cost is based on how much the stock moves on a day-to-day basis and how much the market is moving. But when we have an earnings event, now we have a third form of potential move causer baked into the price of the options, which is the earnings event itself. And when you have big companies like Apple, for example, you'll usually see a negative return on buying options because big funds need to use options to hedge their positions. So I was speaking to one of my friends at one of the big banks, and what he was telling me was that if a pension fund has like over 3% of their portfolio represented by a single stock, they are literally obligated to hedge their position around the earnings events, around big product releases, stuff like that. And what you'll end up seeing is the price of those options get driven up because there's so much demand for them and so little supply. And when you have a situation like this, the price of the options starts increasing, right? If you've taken like, level 1 economics, it's supply and demand with like a price equilibrium, right? So the price gets driven up for these options. And that means that the stock needs to move more for buying that option to be profitable. And that's why when we're selling them, we're collecting that inflated premium and we're able to keep most of it because it's not actually going to move that much, but a lot of people are obligated to buy it. Now you have those people that are obligated to buy it, that drives up the value of the puts. And then you'll often see the value of the calls get driven up too, because in the retail space, the majority of people are not actually trading options correctly. What they're doing is they're using them for a directional bet. So they're using them to actually go out and say, I think Apple's going to go up. I'm going to buy a call on Apple, regardless of how much that call costs. So we're able to go in and using a tool like this scanner here, we're able to filter through opportunities to find the ones that are overvalued, and then we sell those. So this filtering mechanism is extremely important for trading any strategy. And it's this filtering that actually sets us up to get rid of trades that would cost us a lot of money and only take the ones that are like really juicy for us to be either selling options around or taking a long volatility position on. So let's see if there's anything that's understated right now coming up in the next few days. Implied move versus realized earnings. Let's see, SPLK. Let's take a look at this. Just enough volume. Let's have a look. SPLK. Okay, yeah. So here's one where you could potentially take a long volatility position. For the first time in a while, it's actually understating how much the move is going to be. It's not a huge edge though, so it's not something that like I'd really take super seriously and spend a lot of time on. But historically it's been negative, but you do get these little pops where they actually beat on earnings. And when I say beat on earnings, I mean beat how much they move on earnings is more than what was anticipated. Actually, I'm going to pause here and I'm going to go over a really important concept with you guys about how to know how much a stock is going to move on earnings. Right? I sort of briefly touched on it before, but I think it's worth revisiting because a lot of people trade earnings. A lot of people see them as gambling, but I'm telling you guys, we've been trading earnings for 2 years now. So that's 8 earning seasons we've been trading, and we've absolutely crushed it. So our portfolio, right? My partner and I manage a private options fund. We see on average 70% a year just from trading earnings events, right? This season alone, we've made $40,000. There's a lot of money to be made here. I've seen a couple of other people that have made hundreds of thousands of dollars in these earnings seasons, especially this one we just had was a phenomenal earnings season. Guys in our group made a lot of money in that academy I was telling you about. It's really profitable. But we need to be conscious of how we're analyzing these positions to make sure that we're not looking at information that we think gives us an edge and trading on that without knowing that it gives us an edge. So the important thing to understand about earnings trading is what is tradable information versus what is baked into the market. And when I say baked into the market, what I mean is that the market is actually future looking. So if today the stock is trading at $100 and we think it's going to crash in a week, the price is actually going to go down today in anticipation of that future crash. So when we're analyzing earnings events, we need to be conscious of the fact that information that is publicly available is already going to be baked into the price before the event. So if we go into an earnings event saying, hey, Baidu beat earning, they're crushing it on revenue. They're having, really, really good returns. I'm going to buy an option here because they're going to go up like value and crazy when they come out with these great numbers, right? You see that stuff all the time on stock forums, right? Like, a lot of people that I've gotten into discussions with, they're like, dude, you don't know what you're talking about. Like STNG has 8 billion barrels of oil sitting out at sea. And like that, they collect $10 of premium every month. And, that's an extra XYZ revenue. And I'm like, okay, cool. Like great for the company. Where's your edge? Because I know that too. Every single analyst looking at this knows the odds that you're smarter than these analysts because you did some simple math is probably pretty low because these guys did it too. We can't be trading on information that everybody else has, which is why we built this for ourselves. So we can start visualizing beyond just the price charts, beyond just the, publicly available information to start looking at where can we find a real edge. And what we need to be looking at is how does the market react to things, not just what information is the market being fed. The market reaction is where the real edge lies for us as retail traders. Think about this. Selling options around earnings is a very cool spot to be because of a couple things. One, there's a lot of different factors that give us edge, right? So, Tasty Trade was off to a great start saying sell volatility, but they made it too general and too easy. They said, just sell volatility. Selling volatility is profitable. And that is actually an incorrect statement because you'll get a lot of small wins, but you'll have some big losers that crush all your gains. And if you backtest a strategy like that, what you end up seeing is that it actually has a negative expected return over the long run to blindly sell volatility. So a tool like this, what we're doing is we're filtering opportunities based on factors that we know are correlated with a certain event happening. So we come up with an idea and then we look at the evidence in this tool, for example. There's other ways to look at it too. You can manually do it yourself. And we look at the evidence to say, okay, what is the market thinking is going to happen here based on everything that it's considering? And, then we look at it and we go, okay, but like all this news is known. If there's no surprise, they're probably overstating it. Somewhere we made an absolute killing was in the airline industry and the cruise ship industry, because with their earnings, people were coming out and saying, this stuff is going to go tanking. They're going to release the worst earnings. Get ready for them to have a major drop. It's happening. Here we go, guys. And when they actually came out and released the news or released the earnings, yes, they were bad, but we already knew they were going to be bad. We already knew it. So when it came out and said, hey guys, you know, I got to sell my cruise. I can't afford to run this cruise anymore. Whatever the hell they say. We already knew it. So there was absolutely no move, and the market was implying a major move. Like, let's take a look here at Dow. I think Dow was one that we killed it on. Look at this. Implied move. Look at the guy. Like seriously, guys, look at how good of a trade this was. Implied move for April 22nd, 2020 was 21%, 20.8%. Actual move, 2%. We made an absolute killing. Let's take a look at another one. Let's look at UAL. Right? Not as drastic, but still pretty bad. Implied move, 16.6%. Actual move, 10%. So extremely overstated once again, right? You ended up losing, 6% of your portfolio if you were long there, right? Let's take a look at RCL. Let's take a look. Once again, implied move, 7.6%. Actual move, 1.3%. So you see here, guys, the implied move by the market, the price of the options reflects the market sentiment. It reflects what the market thinks is going to happen. But as we can also see, there is a ton of irrationality here. Markets are not rational. So when they're not perfectly efficient, as some people would try to lead you to believe. Think about this. If a market was perfectly efficient, there'd be no trade ever. It's only when you have a disagreement with the market that there's a trade. And if the market's perfectly efficient, nobody could ever make money. So that's obviously not efficient. And looking at this type of stuff, I hope you guys are able to see where we get our real edge from, right? We look at these things, we go, why is there such a big move? Where's the surprise coming from? No surprise, let's short it. We think there's a big surprise coming, let's go long, right? We're usually on the short side because that's just a part of our earnings strategy. But I hope this makes it clear that, guys, like, this is the value of applying data and intuition to trading. This is what professional traders do on a day-to-day basis when they're breaking down ideas. They're doing research, they're finding new edges, they're building models to execute on it, and they're structuring trades to capture those edges. Gone are the days of just being able to use a price action chart to visualize. Think about it. We have computers now, guys. Everybody is using some form of data, whether you're looking at the price action, the fundamentals, the technicals, or the quantitative data. But what the professionals have been able to do is, instead of trying to process all of it in your mind, they can upload it to a computer and let the computer handle the heavy processing work, leaving them to filter opportunities, to find the right trades to take, and to actually basically act as more of a decision maker rather than an analyst. The tool does the analyzing while they make the decisions, right? So this is not some algo BS scammy crap that, like, you see pushed on Instagram and everything. This is not some Bitcoin algo. All this is the application of simple statistics and information to your trades. So you're taking your intuition to go, I have an idea. And then you're putting it to the test with data to say, how would it have done historically? What is the market saying is going to happen now? And then you're applying another level of intuition to say, why is this happening? Why am I seeing this inefficiency? And when you can answer all these questions, the only thing left to do is to go onto your brokerage and structure a trade that lets you take advantage of that inefficiency. So, a lot of people look at options and they go, oh, I'm going to buy a call or I'm going to buy a put. But what they miss is that the actual juice in options trading comes from being able to structure out different trades using a combination of puts and calls, right? Whether it's a calendar spread, whether it's a iron condor or a straddle, there are so many different types of trades that you can make within the options world. And it is so juicy. It's so juicy. As a retail trader, it's probably the best spot to be if you're willing to put in the time to learn these things. Because, what we're doing with the group of traders we're working with is trying to give them everything we learned in the last 5 years, right? We were lucky enough to have some mentors really show us the right map to be following early on in our trading careers. It only took us 2 years to realize that technical analysis wasn't going to get us there and that we needed to be learning new skills and updating our maps if we wanted to really make it in this field. And then the last 5 years have been spent doing that. And it's gotten to the point now where we are 25 years old, managing just under $1 million in raised capital and averaging between 70 and 100% year over year. We won the biggest options competition in Canada, audited by the Toronto Montreal Exchange, which is the options wing of the TSX. So, this is the juice, man, right? We have 5 people on this live right now. So for those of you that are here, I hope you find some value in this. I'm going to be going live every day. If you haven't already, please make sure to subscribe. And if you have a friend that trades options and is really passionate about it, please share this live with them, share our page with them. We have a lot of really good content coming out in the near future. I do this live every single morning to break down trades. So I'd love to have you guys back here. Come back. I'll break down any trades you want to look at. I'm going to be doing a lot more of these little rants where I just talk about trading. I try to share some of the value that I've been able to gather over the last few years that have helped get me to where I am. I'm going to get my partner to where he is. And if you guys have any questions, you can either send me an email at sean@predictingalpha.com, or you can message me on Instagram at predictingalpha, or you can leave a comment below. I'll come back. I'll take a look at it again. Don't leave it in the live chat. Leave it on the video, and I'll be really happy to get back to you. But that's going to do it for today, guys. Really appreciate your time. Thank you for tuning in, and we'll see you on the next live tomorrow. Peace out.